So that being said, hey, for those of you that don't know me, my name is Hema. I want to pass it off to Stephen for a really brief introduction.
Yeah, hey there, Steve Lobb. Super excited to see everybody here. I know a few names in the audience over there. But yeah, it's working here with the Streamline Capital team with Brian, Steven, Hema, and Derek. I'm a co-sponsor on this effort, and prior to this, I've been an LP on two projects and a GP on two. And this is going to be taking me to over 400 doors. I'm super excited about it. It's already under contract, operating, and beating the plan, which you're going to hear more about today. So I'm sorry if I spoiled the secret there. But Derek, over to you.
Thanks, Stephen. Good to see everybody. I'm currently active duty, but I'll be retiring here early next year. But most people know I've been involved in real estate for about 24 years. I specialize in construction and rehab, and my portfolio spans flips, residential, commercial residential, over 100 properties at this point, and just started a remediation company. So I'm super excited to be a co-sponsor as well and work with Brian and team. I've got a lot of faith, but also as a major contributor in investing as a limited partner as well. So I'll be followed by Brian. Thanks, guys.
Awesome. All right. Well, I'm going to share the screen. There we go. Can everybody get a thumbs up if everybody else can see that? Cool. All right. Awesome. So welcome everybody. Brian Briscoe with Streamline Capital. First thing we're going to overall today, what are we here to discuss? The South Salt Lake portfolio. And it is actually in the city of South Salt Lake. And if you're driving between Salt Lake City and South Salt Lake, you wouldn't even notice the difference. For all intents and purposes, this is Salt Lake City. All right. So multifamily investment opportunity, 80 units. And, here are some projected numbers on the board. We think this is going to be an amazing deal. There aren't really a whole lot of really good deals on the vine right now, and we were able to snatch this one up. And we're going to talk about, why this is such a good deal. Okay. Snapshot of the returns. We'll explain those. We'll explain the dash later. Actually, I'll give you a little preview right now. We have two different classes of shares. And, for people who can invest a little bit more, we're giving a little bit more of the returns. You're giving beneficial splits to the investors that can put more money in, just to incentivize, the people that can to reach a little bit deeper in their pockets for it. But so the higher number is for the people for the second class of shares, and that starts at 250,000 for an investment. We actually have 6 people at that 250 right now, and we have enough room for 8. So for anybody who is contemplating that, there's two of those spots left. And then it says minimum investment 100,000. That's a very squishy number. In the portal, we have 50,000 of our minimum, but 50,000 is the minimum. This, I think we forgot to change that. But that said, first thing we're going to talk about is the management team. And I'll give more of an intro to myself in a minute. We'll have Stephen. Stephen, do you want to do your intro now or when you do your first slide?
Oh, I'll do it right now. Yeah. Okay. Stephen Richards, I joined Brian. I partnered with Brian earlier this year. I started my real estate career out in New York City right after I graduated from Brigham Young University, and was there for a few years. And then I moved back to Utah during COVID and started a job at Marcus & Millichap selling retail properties. Really big background in management, leasing, asset management, and overall just apartments. And so I'm super stoked, super excited to be here, and have loved working and partnering with Brian since earlier this year.
All right. And Hema, you're up.
Hey guys, I'll be quick. I'm currently in DoD Skills Bridge intering with Brian, but I've done 14 different limited partnerships where I've invested capital only. Started back in 2019. One of those deals was with Brian, and he overachieved on those returns. I've gotten to know him since 2018 or so. I've then since turned to be an active investor myself. This is my third syndication Really glad to be on this team and working with Brian. He's already proven to me that he delivers results. Brian, over to you.
Thanks a lot. And him and I, that sounds weird if you blur those words together. We used to sit in the Pentagon courtyard, planning how to, buy all the multifamily in the nation, for a while. But she had a very prestigious job there, and I had one of 35,000 very non-glorious jobs in the Pentagon. But so yeah, we've known each other for quite a while, and anyway. So actually, before I go into my bio, why do I put the group first? And here's my opinion on what's important when it comes to investing in something like this. All right. Number one thing, the people. All right. The people that are involved, I would say, are more important than anything else. Okay. A lot of times you hear what's the three most important things when investing in real estate: location, location, location. Yeah, that's important, but a good sponsor can take a really, let's use the opposite example. A really bad sponsor can take a great property in a great location and still run it into the ground. All right. So the number one important thing is the people who are running the property. I think the second most important thing, now we're talking about the location. I mean, you can take a good property, put it in a bad location, and it's going to perform poorly. You can take a relatively bad property, put it in a great location, and it's going to do a lot better. So I think the location is the second thing. And so we're going to tell you, why we think Salt Lake City is a great place to invest. And third thing, and I'm in order of importance, is the actual property itself. Okay, so the team, the metro or the location, and then the property. And that's the order that we're going to go through as we're doing this. So a little bit about me. Why do I get a little bit more time on my bio than everybody else? Well, the buck stops here is really, why that is. Okay. So I was born and raised in Salt Lake City. So this property right here is not very far from my old stomping grounds. I mean, the White Pines Apartments is about 6 blocks from the favorite place. There's a little malt shop on the corner of 9th and 39th that I used to beg my dad to take me to all the time. And so this is a total of, I think, 8 or 9 blocks away from that. But yeah, born and raised in Salt Lake City. I got married in Bountiful, Utah, which is just north of Salt Lake in Davis County. In 98. I am older than I look, is what most people tell me, and I'm sticking with that. I don't care what you guys think. I'm older than I look. But anyway, we have 5 kids now. My oldest daughter, 25, she also lives in Salt Lake City right now. Daughter number 2 lives in Seattle, Washington. Chased a boy to Seattle, and they're getting married soon. So going through life, I mean, I followed the traditional path: get a degree, try to get a good job. So I got a bachelor's and master's in math, both from the University of Utah. Incidentally, the Utah campus is about 5.5 miles from these properties. So once again, still right in my old stomping grounds. And I decided I would go to the University of Minnesota to pursue a PhD. I wanted to be a mathematician or a college professor, math professor. And a couple weeks after I show up to Minneapolis, September 11th happened. And I'll say it's not a coincidence that I retired from the Marines, 20 months or 20 years and, 45 days after, September 11th, because that's what got me to join. But I retired in October of 2021 as a lieutenant colonel. Spent the last half of my career in international affairs. I know we have a fair amount of military and vets here, so I was a foreign area officer, if you know what that is. But as far as real estate goes, I bought my very first single family rental in 2007, also in Salt Lake City, and picked up a handful of rentals over the years, and realized I had stumbled on something that was performing a lot better than stock market and every other investment that I had made, and decided to get into apartments Got into a coaching program in 2018 and, never looked back from there. Co-founded a company named Four Oaks Capital. They're still around. Shortly after I retired, I moved across the country, but that company had a regional focus, Carolinas and Georgia. And there's lots anyway. Moving across the country kind of took me out of the loop with that, and so left that company. To date, I've been a general partner in over 1,600 units nationwide, including 23 different apartment complexes. And there's all the states that I've invested in. And I'll say one thing about that is, with properties all over the nation, I realized at one point that what would be the most important thing for me going forward would be focus, focusing on one area and being able to get a lot more out of one area. And it just turns out that my hometown is a great place to invest. One question, and I think rightly so, that I get a lot is, what's your track record? How well have you done on deals? Well, here's a list of all of the deals that we have taken full cycle. Total of 8, depending on how you count. The very first one's 2-property portfolio. But, for the most part, we have exceeded exceeded the projections. We do have, the top and the bottom lines that didn't quite hit our investor thresholds. And actually, low country townhomes, we did project a little bit more than 15%. So this one also came in slightly below our mark. I think we projected a 16% on this one and came in at 15. So for the most part, 27, 23, 27, 41, these are all average annual returns. For the most part, we've done very well. The top one, I'll explain that away by saying it was my very first one. And I now know why everybody says that you shouldn't invest with a brand new operator, because we made a lot of mistakes there. Fortunately, that was, 5 years ago. And the last one, this was more of a product of the market. Market softened, and we decided to get out. We talked with a lot of our investors, tried to get an idea of what they wanted. And most people said they'd rather have their money back with a small return than wait for a couple of years for the market to rebound. And so that's what we did. That said, I think I'm passing the baton over to Stephen now for the market overview.
Yeah, of course. I appreciate it. So like Brian's mentioned this a few times throughout his introduction of how awesome Utah is. I like Brian, I'm a Utah native. I was born and raised here in Utah. I lived in New York City for about 5 years. But other than that, I've been in Utah, and I love this area. And I love where these properties are at. I know them very well. And Utah, I don't just think it's awesome. The country thinks Utah is awesome. Utah was ranked #1 in the nation for the 2nd year in a row, just a couple months ago. And there's a lot of factors that go into that. But Utah, as you guys can see here on the slide, is ranked in the top, 3 or 4 or 5 nationwide in all these different categories. We have the best growth. We're the best state to start a business. We have the best economic outlook. And that one, I'll show you a slide here in a minute, but that's been for 17 years in a row. Utah's been ranked #1 for the best economic outlook. Great job opportunities. We have 2 of the top 5 cities here in Utah. And Salt Lake City itself was ranked #4 in the nation as best cities or performing cities. So a lot of good attention for Utah. A lot of people are coming to Utah. A lot of people love being in Utah. And that takes us to kind of the demographics of what Utah looks like. And so, Brian, on the next slide, we'll see Salt Lake City proper, or Salt Lake City itself, has about 1.2 million people. The median income is $82,000, and unemployment is really low. Median age is 33. So these numbers are significant for a few reasons. The median income specifically for here in Utah is $8,000 higher than the national average. So people here do really well financially, and they make good financial decisions, and they're able to have a good life here in Utah. So what that means for us and how that translates for us as investors is we are very confident that our tenants can afford the rent and continue to pay rent. That goes into the unemployment portion here as well. It's our Utah's average is 3% unemployment when the national average is 3.9%. And then the median age here in Utah, it's a very young median age compared to the national average. And people here love having children, and people here love staying here, and people here love coming back if they've ever left, kind of like me. I left and I came back. And so with that in mind, the population is expected to grow within the next 3-4 years another 8.3%. And so the demographics here in Utah is only getting better. It's only getting bigger. And just like us, people want to be here in Utah. Next slide here, Brian.
Okay.
Some cool newsworthy studies and notes here. We've mentioned a couple of them. Utah has the hottest job market. People love being here in Utah. These are from highly, some really strong sources and good journals. And so we're happy to be a part of this growing. This is from the Wall Street Journal. So really strong growing market where, like I said, people want to be here, businesses want to be here, people want to stay here, people want to move, and that just makes it so much better for us here in Utah. And then on this next slide, you'll look, if you guys have seen the news, obviously this was in the news just a little bit ago, but Utah is going to be hosting the Olympics in 2034. And obviously the Olympics bring a lot of economic growth to a city. And since we've hosted it here before, if any of you have been to Utah especially during the winter months, you guys can go skiing at a lot of these facilities or ice skating. And so a lot of these facilities that we used back when the Olympics were first here, when I was just a little kid, right, are still being used and will be used again here in the 2034 Olympics. And then, like I mentioned here, Utah was ranked for the 17th year in a row with the best economic outlook. It's pretty remarkable to get that accomplishment 1, 2, 3 years, but to have it 17 years in a row is pretty mind-blowing. The nice part about where these properties are located within Utah, within Salt Lake City, is that on the next slide, you guys will see it's cornered between the 2 largest freeways here in Utah. So we're considered the crossroads of the West. When I worked at Marcus and Millichap, we shared a floor with the Utah Port Authority, and they came and they told us about how much traffic comes through Utah, and 80 to 85% of the nation's GDP travels through Utah. And that's significant because obviously that just means that we are the crossroads of the West. 80 to 85% of the nation's GDP comes through Utah. And these 2 properties are located, like I said, right in the corner, next to I-80, which goes east and west, and then I-15, which goes north and south, which is pretty remarkable. Utah also has a super strong workforce industry. We have an incredible cancer hospital research facility here at the University of Utah. We have Intermountain Healthcare, we have Goldman Sachs, we have Amazon. And so Utah provides not only a great place to live, but a great place for working individuals to create a career. And that's what we want. We want our tenants to have a good life here in Utah, and we want to be able to help provide that. And obviously, there's a lot of working opportunities for them here as well. Brian is going to love this next slide because it focuses on his favorite university, which is the University of Utah. They are an incredible research school. This year, they're not a great football school, which is awesome for me because I'm a BYU guy, which is the Y further down on the map here. And so here in Utah, we have so much education, and some of our students are attending the University of Utah, and it is about 15 minutes away from the University of Utah campus. And so it's such a good location for students who want to live in our apartments here. But we have it's not on this slide, but further up north we have Utah State University, we have Weber, we have the University of Utah, all the way down to Provo, where we have two of the other largest schools in the state, the Utah Valley University, which is the largest attended college university here in Utah, and then just next door is BYU. So this gives you kind of an idea of where these schools are located. All of them are really close to I-15, which is, like I said, one of the crossroads that goes north and south here in Utah. And we're just right in the heart of that. And as we go on, we'll talk a little bit more about that, but I'm going to pass it back off to Brian for some investment highlights.
All right. Okay, so I'll talk some highlights, and then but 80 units is what it is. There's two properties, and the whole from the beginning, every slide, Salt Lake portfolio, two properties, and I'll tell you why that's important. In commercial real estate, the best and most efficient way to manage a property is to have on-site staff, right? But the smaller the property, the less efficient monetarily the on-site staff is. And typically it's around 75 units where on-site staff is, the affordable option as well. So these two properties are about 1.5 miles away from each other, and we're able to manage them as an 80 unit instead of, two separate properties. Okay, so we have a full-time leasing agent, and we have a full-time maintenance guy for both these properties. And if we had just one property or the other, we wouldn't quite have had that extra synergy there. Or if they were further away from each other, that wouldn't quite have worked as well. But anyway, White Pines is the larger of the two, 56 units, and that's where our office is. And then Blair Street Apartments is just to the north of that, and we'll put them on the maps right here. So we saw the bigger area map up front. So we're going to dive in a little bit. Stephen mentioned that both these properties, from Blair Street, you can get on I-80. It's about 1/2 mile to I-80, and from White Pines to I-15 is about 1/2 mile. So interestingly, you can get almost anywhere from these properties. You can get almost anywhere in the Salt Lake Valley within 15 minutes without traffic, with exception of this southwest corner right here, just because of how close they are to the freeways, the belt route and whatnot. So very conveniently located inside the city to get just about wherever you want to get to. And then this inset right here, you can see how close they are. This is 3rd East. Incidentally, we do have another property on 3rd East, which is just north of this one as well. So these actually go very nicely with the rest of our with the other property we have. Incidentally, Nibley Park Golf Course, I'll tell you how great of a golfer I am. I've hit par on a hole one time, not on an entire course. Par on a hole one time, and it was at Nibley Golf Course. But I'm not a good golfer. Anyway, as far as the location goes, we've got a really solid location. Something else to note, if you look at where the path of progress is, you have downtown Salt Lake City. We have a lot of growth going in downtown right now. But directionally to the east, between downtown and Salt Lake City is where we're seeing a lot of growth. And then to the south, okay, we have a big freeway right here, and railroad tracks too. So there's not a lot of growth going to the west. But for the most part, downtown to the east and downtown to the south is where we're seeing all the growth. And just within a 1/2 mile of both these properties, we have brand new subdivisions. We have townhomes that are brand new. We've got buildings that have been demolished and new buildings popping up in their place. So this is definitely an area that's going to be better 5 years from now, 3 to 5 years from now when we look to sell the properties. As far as the highlights, this is what we paid for it, and we have closed on both properties already. And in a way, I'll go off script a little bit, but in a way, having closed on both properties does de-risk it to the investors a little bit. All right. One of the biggest risks when investing is, the sponsors like me, we get the money together before we purchase the property. There's always the, what if something goes wrong and you don't purchase the property? There is a chance that people lose money without even getting to the purchase. The other thing is there's a lot of times where, if you're investing early, your money sits idle. Anybody who invests in this property, we're going to backdate your investment to the day that we closed on each one of the properties. So you're going to be getting slightly more benefit there. So there's a lot of things here that de-risk. We've also had, a couple months of operations, and we'll talk a little bit about that, later in the presentation as well. Hold time, we're looking at about 5 years on this property. And I have we're estimating that 5-year mark. We might sell a little bit earlier, and we might choose to hold it a little bit longer, depending on market conditions. But one thing is, we will, reach out to our all the other members of the GP. And, when we get to that time, if there's not a clear, do we hold, do we sell, or do we refinance? We will seek investor input to see what the majority wants to do. But for the most part, we're planning about a 5-year hold on the project. Total equity, $7.5 million. We raised enough money to close on the properties, and we still have renovation budgets to fill and a couple other things there too. So as far as the highlights, here is the structure. And I mentioned at the very beginning that we had 2 different classes of shares. We have a set of Class C shares. And as I mentioned, $250,000 is the minimum investment for Class C. And then our Class D shares, for all intents and purposes, we'll take down to 50,000. We would like to see $100,000 increments, but we will take slightly lower on that. So I'll explain what a preferred return is, just in case there's 1 or 2 people that don't know what that is. Essentially, a preferred return means that we are paying 100% of the profits to the investors until we have paid them this percentage return on their money, averaged over time. Okay. So for $100,000 investment, if we had an 8% pref, I don't make a penny until we've paid you, 80,000 per year. All right. Until, we're either selling or refinancing. Okay. So essentially we are front loading the profits, sending 100% of the profits to our investors until we meet these preferred return numbers. Okay. And as you can see, the people the Class C shares, you get a higher preferred return, which means it takes us a little bit longer to make money, or you make more money before you start splitting the cake. And then the LP-GP split here, that's the profit share after we've achieved the preferred return. Okay. So basically you'll get 100% of all the profits until you've reached the preferred return amount. Based on what class shares you purchase. And then after that, every dollar is split either 80-20 or 75-25 between the LP investors and the sponsors collectively. All right. And incidentally, I'm also an investor in this as well. I put my money where my mouth is in all of these projects. So now going a little bit deeper on the Class C shares. Here's the numbers we expect to hit. Now, full disclosure, when we look at this, right now, there's a lot of distress in the multifamily market because of where interest rates have gone. So part of our stress test on this one is, are we going to be able to hold this longer in case, the market doesn't recover as fast as we think it will? And so the equity multiple is based on a 10-year period. But, if on a 5-year investment, we're still going to be hitting about the same cash on cash the same average annual return and the same internal rate of return. But these are our targets right here for Class C shares. And Class D shares are going to be slightly lower, so slightly lower cash on cash, slightly lower average annual return, and a slightly lower internal rate of return. All right. Now, one thing, this is also, how we're projecting our numbers. In commercial real estate, there's something called a cap rate, and it took me several years to understand what that cap rate was. But you can look at it as kind of an indicator of market pricing. Okay, so but if you don't understand what cap rates are, ignore this and just look at what's over here. Okay, so if the market pricing is worse than today, okay, this is essentially how we projected our returns. Okay, the second line down is where we have a market cap rate or market pricing multiplier about the same as today. But looking at a market 5 to 10 years from now that is worse than today is how we are getting our average annual return, or our IRR, of 15.9%. Right. If we have approximately the same pricing as we do today, this just changes our exit price. We think we're going to hit an 18%. We project an 18% IRR. If it's slightly better than today, that's moving from a 5.1 cap to like a 4.8. We're really close to a 19%. And if we get back to the cap rates we saw, or to the pricing on the properties that we saw in early 2022, the numbers get a lot fatter, a lot quicker. So 22% average annual returns if market pricing gets back to where it was in 2002 before the interest rate started going up. All right. Okay, and then I think this is my last slide, but this is a 506c security offering. And what that means is you have to be an accredited investor to invest in this one. And if you want to jump into this slide more detailed, the slide deck, or a version of the slide deck, is in the investor portal as well. We have a couple of slides coming up that are going into finances and numbers. But essentially, here's all the money that we're using, and this is where we have used it. It's called the sources and uses. So we got 12.1 million in debt. We're raising 7.5 million total, for a total of 19.6. This is our total capitalization. And then down here is how we're going to spend it. 800,000 is going into capital improvements, 80,000 into operational reserves. We have $250,000 sitting with the lender right now in interest reserves. And that's just to make sure we can make our payments. But anyway, this is all the sources and uses, where all the money is going. And of course, there is an acquisition fee that for this, and then about 200,000 in closing costs. So there we go. And Emma, has there been any questions that we need to hit up? I haven't seen any.
Nope,
When I'm
not
in
yet.
full screen mode,
I'll flag it if there's one.
Okay, sounds good. And just a reminder while I'm on that, there is that question button. Depending on how your screen is set up, for most people, it's going to be at the bottom of your screen. Go ahead and click that and just type in your questions. At the very end, if you have questions, we'll open it up so that people can jump on and just ask. So that said, Stephen, turning it back to you.
Yeah, appreciate it. So we're going to go over kind of what our plan is here for these two properties. I wanted to start off with a cool story with White Pines. When we were looking at this deal, it had gone under contract before we were able to put under contract, and it fell out of contract with the previous buyer. We were able to get it back under contract. We found, like Brian mentioned, how close this property was to Blair Street, and so it just made sense for us. But we were able to talk with the sellers and found out that just because of how they had their loan structured, they were losing money on this deal, and they needed to sell the deal. And we were in a really good position to take it over. And so when we looked at it, we decided that some of the value that we would bring to the table was they had already done all the interior renovations. And so everything on the interior was taken care of. So we focused on the exterior. And something that Brian says, which I love, is the exterior helps retain tenants, and it helps tenants show up or potential tenants show up to the property and see what they're going to be living in if they choose to live there. And we want them to feel great about it. And so some of the things that we've done here at White Pine specifically is we're redoing a roof, we're redoing the parking lot structure, we're removing trees so that we can add storage units, which will produce income for us. And I'll go into that a little bit more, but we've also redone the decks, and we're going to be adding an amenity package. There's a playground area that we're going to turn into kind of like a family area / dog park. And so we'll talk a little bit about that more here on the next slide.
All right, I guess that's my cue to go to the next slide. There we go.
Yeah, so here are the basics of what we're going to be doing. So when we did the initial walkthrough on this property, there were 5 tenants who were paying rent for pets. But when we found, what we found was that there was about 40 tenants who had pets who are not paying rent for those pets. So we're going to be increasing that through better management, increasing our income by about $18,000 annually. There were 28 storage units on the property. We're planning to build about 28 more, and that'll increase our NOI by $12,000 a year. And just walking the properties, I go there about once a week, but just walking the properties and talking with the property manager there, she says that every tenant wants a storage unit, and that anytime someone who moves out with a storage unit, she gets calls immediately from the other tenants asking to have their storage unit so that they can use it, and their parking spot as well. So we'll increase our revenue that way through management, through our better management, 18,000 through pets, and 12,000 through storage units. And like I said, we'll be adding a gondola and a nice little off leash dog area, and updating the playground there.
I think you mean pergola, not the gondola.
Pergola.
Yeah.
I said gondola.
It would be really awesome to have like a gondola taking us straight to the top of the mountain from there. But
that would be wild. That would be
yeah,
that'd be a crazy
let's
ride.
do it. It'll probably only be like 100 million, but anyway.
Thanks for the correction there. And so on this next slide, you'll see kind of what the property looks like. All of the interiors on White Pines are the same layout. They're all 2 bedrooms, 1 bath, and they're just mirrored. And so when they did the renovations, they all basically look the same like this on the right hand side of the interior, and then the exterior looks really good. We're just going to create uniformity around the whole property. So they had 4 different contractors. Like I said, they were running out of money because of their variable rate interest loan, and so they had 4 different contractors work on the exteriors of the properties, and eventually just ran out of money and couldn't finish the job. So we're coming in to finish the job and make it look nice. And then there's some progress photos here on the next slide where we've been able to remove trees, do the roof work, and work on the decks. And so we're already in progress of making these changes happen, just so our tenants are a little bit happier. So let's go to Blair Street here now, Brian. So with this here, Blair Street has a really cool story behind it as well. So the last property, the seller lost about $1 million selling it to us. This property, for those who know real estate really well, there's a big difference between a residential agent and a commercial real estate agent. And we were fortunate enough to work with a residential agent. Unfortunately for the seller, he was using a residential agent to sell a commercial property. So we had this deal under contract at it was above 5 million, and then the seller got another offer that was above ours. So we weren't able to get the offer or get the deal done, and then that buyer fell out of contract, and the seller's agent gave us a call and was like, "Hey guys, the seller will sell this to you for 4.8 million, and which is well below what we had originally offered. And so we put it under contract that day. And as we did inspections through our process of getting a loan for this, the inspector found that there was a 25% vacancy, which was against our contract, and that affected our loan greatly. And so we ended up going back to the seller and saying, hey, listen, the vacancy caused a major issue with our loan. This is what the numbers look like. We're asking for a $300,000 price reduction. And he gave it to us, and we got an extension. We were able to get the deal done. And so that ended up being about $187,000 a door. And market here is close to $230 to $250 a door. So we crushed it on this just by playing the game right, and by having the right people in place to make those changes happen. The nice thing about this property too is that the previous seller has owned it for about 15 years, and he took really good care of it. We have a small value add plan here where it's going to be mostly exterior renovations, and the main thing that we're going to do is just make the properties look newer on the outside. So we had ROI by Design draw this up for us, and so this is a rendition of what we're going to make the properties look like. And so on the next slide, Brian, we'll go into a little bit more about this. So on the left, you'll see that the properties, they have these mansard roofs, which Brian loves mansard roofs.
I don't.
He hates them, and for good reason, right? So mansard roofs came as the Americans were trying to be cool and follow the trends of the French. But the French put in mansard roofs for tax reasons. But we just did it because they were doing it and we thought it looked cool. But it prevents, or it provides some, it doesn't last very well. Leaks happen. And so luckily here, everything's in good condition. After our inspection report, everything is still good condition, but we're going to make it look nicer. We're going to put sheet metal siding here, get rid of the shingles, and we're just going to make it look really nice. And so that's the main value add here. And we're obviously going to paint the exteriors. Something that was interesting about this property is the previous owner didn't allow pets. And so we're going to allow pets and increase the revenue that way. He also had coin operated washing machines on site. So they're not in the units. There's a little washing machine and dryer facility just right outside that we own, and they were all coin operated. So we're updating those to make them app based, and we'll increase our revenue that way. And then he had a very small overcharge for his tenants when he operated the property. So we're actually going to implement RUBS and recapture about $3,000 to $5,000 annually. And so he also didn't charge for parking. That's another thing we're going to charge for. And they have storage units on this facility as well. So just with professional management that Brian and the team will bring to this property, we'll just we crushed it on the front end. We're going to crush it on the back end, and just super light value add just to make the tenants happy. So on the next slide, you'll see kind of what it looks like now, what the interiors look like now. It's just a nice, cozy place. It's in a private area off the main street, and so the tenants love it here, and for good reason.
All right. Oh,
since Brian mentioned this earlier, we have purchased this property, and so we've been able to, or these properties, and so we have been able to see how they've been performing. Our occupancy is higher than we projected on both properties. We've collected more income than we expected to for both properties. And so with our projections, we're confident. Obviously, we've owned them for a month, and 1 month for one and 2 months for the other, but so far they're on track, and we're happy to say that.
all right. Now I'll go real quick through the finances. And for those who are numbers oriented like me, I mentioned at the beginning, I do have 2 degrees in math. And so instead of nerding out and putting everybody else to sleep, the numbers, the slideshow is available in the investor portal. and I'll just kind of briefly go through the numbers on here. So as far as, debt, I think, what's important about debt is, I think, two things. Number one, it's got to match your business plan. And number two, it can't be, overly aggressive. Okay. So, Blair Street Apartments, we are getting a Freddie Mac loan, which is, agency loan. It's government backed. It's a 5-year loan, 2.8 million out of $4.5 million purchase price. That puts us right at 63% loan to value. Okay, that is a very safe number. Okay, so we're getting we got a really good deal on the property. We're going to be able to raise rents really fast. But on the flip side, we have a very low loan to value, which means very safe for us as far as when it comes to refinance. So basically, if the market does poorly in the next 5 years, we are still going to be able to refinance out of the property and get into a new loan and extend it longer if we have to. Okay. We've also negotiated to get a better prepayment schedule. Most commercial loans come with prepayment penalties, but this gives us a little bit more flexibility so that we can exit a little bit earlier. Bottom line, the normal prepayment schedule is a little bit more higher fees. So that's Blair Street Apartments and a 5 actually, I think that's a typo. I think it's a 5.32% loan, interest rate fixed. Then White Pines Apartments, this is a slightly different type of loan. On this particular loan, they're actually funding the renovations for us. But still, you look at our loan to value, 70% loan to value. Once again, and that's all inclusive. Once they've funded all the renovations, once again, that's a very safe number. So push comes to shove, if the economy doesn't do very well in the next several years, and we got to refinance out of it, we'll have a lot of room to be able to do that. Our interest rate is variable. Oops, I have a very sensitive mouse. Interest rate is variable, but it's kind of not. We do have what's called a rate cap, which keeps the rate from going up. And the lender had a rate floor, which keeps the rate from going down. So we're essentially stuck at right around the 9% interest rate for the rest of the loan period. Right. So those are the loans on both properties. Now we get into, the projections, and this is mentioned up front that, we wanted to make sure that, we could weather a storm if something comes up. So we did underwrite it to 10 years. But really we're probably going to have the exit, somewhere around the 5-year mark. So this is what the projected returns for Class C shares look like. And if you've ever, invested in a value add, the first year, the cash flow is not very spectacular. Okay. Why is it not spectacular? Well, we are intentionally bringing the vacancy down. All right. Our occupancy down. We're intentionally bringing vacancy up. All right. We're going to be renovating a lot of things. And we also have a higher interest rate loan on White Pines. And with White Pines, the goal is to get the renovations done as fast as possible, because right now we have a 9% loan, but we'll get the renovations done as fast as possible and then either sell the property or refinance into better financing, something that looks more like a 5% loan. All right. The vast majority of, value add properties use what's called a bridge loan, which is what we have with White Pines, and have a higher interest rate for a shorter term. So that's the reason why, year number one, the returns are not very awesome, but, we're going to be adding a ton of value to this. The goal is to, refinance White Pines around the 18-month mark. And right now we're projecting a cash out refinance, which allows us to start pushing a lot of money back to the investors. Okay. And then once we refinance, we should be going from an interest rate that's about 9% to an interest rate that hopefully starts with the number 5 or lower. which will open up the cash flow for the later years. Okay. If we refinance the White Pines at year 2, we'll be looking to sell or refinance again somewhere around year 5. Blair Street, we have 2 different loans that we have to deal with. Both of them have different terms. And so what's most likely going to happen is we refinance White Pines around the 18-month mark, put lower interest rate loan on it, and then hold it out to about the 5th year. And then on Blair Street Apartments, what's most likely we're going to do is we have a 5-year loan, and somewhere, depending on if the economy or if apartment prices go up significantly in the first couple of years, we could sell as early as year 3. But what's most likely to happen is we have an exit at 5. And like I said earlier, we pushed this out to 10 years worth of underwriting just to make sure, hey, are we going to be able to hold? Are things going to work out if we do that? Yeah, similar numbers. When you look at this over a 10-year period, 100,000, we're going to return 300,000. Over a 5-year period, we're coming close to doubling your money. Projected IRR on both, whether it's a 5-year hold or a 10-year hold, is a 1.5, or excuse me, 15.9% IRR. Okay. All right. Any questions? And as Emma, have you seen anything pop up in the questions yet?
There are 3 questions. I'll start with the first one.
Okay.
Were those acre swamps in swamp coolers in the roofs? I think it was during the photos.
Yeah, we actually have some of both. Most of the units have ACs. I think one building still has swamp coolers.
Awesome, thank you. And then
Good
both
eyes, by the
Victor.
way. Wow. I mean, maybe he works in the HVAC sector, but man, eagle eyes.
There was a same question to different participants. Did the seller say the reasoning for the 25% high vacancy rate of the property? I think this was when Stephen was speaking.
Yeah, that's easy. He went out of town.
So he was an absentee owner?
Yeah, I mean, so it's one guy. He was managing a portfolio of about 70 units. This was his largest property, okay? And basically, he hit the easy button on a lot of the leases, all right? Well, what I mean by that is, what's the fastest way and easiest way to lease up a property? You set your rents really low. And that was his typical MO throughout the entire time he owned the property, is he would consistently list things about $200 below market rates and just get things, leased really, really fast. Well, in April, he was out of town for several months, several weeks, and we had a couple of leases come due during that time. And he's the guy that manages it. He was out of town. Nobody was there to replace the tenants. And so, yeah, the vacancy rate did get up to 25%. When he handed the property over to us, they were fully occupied. They actually had somebody move out like the day after that so when we purchased the property, they were at 100% occupancy. We had them move out within the first week, and we replaced that tenant, had another move out, and we're at 23 out of 24 on Blair Street right now, and we are at 53 out of 56 on White Pines. So overall, we were at 95% occupancy, which is a really, really good number.
Awesome, Brian. Those are all the questions.
That's it.
So far.
Okay. All right. So next steps from here. All right. We have an investor portal. We use a portal called Invest Next. Okay. So the easiest way for people to do investment, to invest from here, is to do everything in the investor portal. Okay. You can log in, you can say, hey, I want to invest $100,000. You'll be asked to create a profile. And in that profile, we are going to need tax information. We are going to give the investors K-1s at the end of the year. So in your profile, you're going to have to set up the tax information for whatever entity. If you're investing just cash from a checking account, you're going to put your social security number in. I see the two questions about funding. I'll get to that in a minute. If you're investing using an entity, you use the EIN. Now, because this is a 506C, we do have to have verification that people are accredited. Couple ways to get that. If you have an accountant, a financial planner, or advisor, that will do that. You can get them to write a letter. Basically, we need a letter from somebody, you know, with a professional license, that says that you are accredited. If you want to use our service, we have InvestNext has a service that we pay for. You can be accredited either by net worth or by income, but you can submit documents and we'll pay for, you know, the verification letter. But there's two options. You can upload your financials to the system. We won't see any of that. It's a third-party verification service. And then once the accreditation letter is taken care of and we can, you know, we have a warm and fuzzy that you're accredited, then inside the portal, you can e-sign the investment documents and then fund your investment to secure your spot. Okay. Now, when do you need to fund by? Well, I'm going to say as soon as possible. All right. We already closed on the properties. You know, right now, you know, what's left over, we've got several investors, several members of the general partnership that have basically, when we closed on White Pines, we were a little bit short on the capital raise. So we have several investors, part of the GP, that put in a lot more money to get it closed. So, you know, some of us are getting a little bit of our money back. And then after that, we have to finish funding our renovation budget, and then we're funding our acquisition fee. So we don't have a hard, fast deadline. We do want, you know, to get this wrapped up as soon as possible. But it's really going to be first come, first served from here. And, you know, once all the spots are gone, the spots are gone. All right. So basically, as soon as you can is the ask. All right. Other questions or anything else?
I think we're good to go, Brian.
Awesome. So yeah, next step, you know, reach out, like I said, to the person who invited you to the webinar. We have about 3 or 4 people that we're sending the invitations out. Reach out to them, let them know how much you want to invest, and, you know, make that soft commit in the portal. If you soft commit in the portal, by the way, we will hold your spot. But yeah, soft commit in the portal for us to hold your spot, and we'll go from there. Thanks everybody for attending, and that's a wrap.
Have a good evening, everybody.
Thanks, everybody. Appreciate you being here.